This interview is for information only and should not be considered as investment advice or a recommendation to buy shares in the company featured. Welcome to this Stock Box interview.
Well, joining us today is Kieran Moseria, the CEO of Cadence Minerals. Thank you very much for joining us today, Kieran. The first time you're appearing on Stockbox. How are you doing?
Very well, and thanks for inviting me to present on Stockbox. It's a great opportunity.
Well, it's good to be talking to you. I know that Alan Green, our research analyst, has talked about Cadence quite a lot before, but it's good to be talking to you and hearing it from the horse's mouth, so to speak. So I wanted just to start us off, if you could perhaps just give us the high-level overview, the elevator pitch, if you like, of the company and what you're all about.
Absolutely. So Cadence is an AIM-listed company. We invest in and help develop minerals and metals around the world. We look to identify undervalued assets and we invest in them at a low price, looking for exceptional returns. And we also look at how good their management is, and having their management involved and being involved with management is really important. So we particularly look at the commodities and chemicals that will provide the transition to electrification, to a net zero world, as well as commodities that we use every day. So in our case, we've been specifically focusing on lithium, rare earth metals, and iron ore, which we use on a day-to-day basis.
Okay, so looking to invest in undervalued assets to deliver, as you say, exceptional returns for shareholders with a focus on the energy metals, the drive to net zero and day-to-day living. Now, I understand you have sort of two branches, if you like, or arms to the business. You have the section where you have the investments, but you have little to no participation whatsoever. And then you've got, of course, the projects where you do have a more active participation, and that's obviously your flagship project, Amapá, which we will talk about a bit later. But let's first of all go through some of the PLCs that you have investments in, but little to no active participation. So the first one, EU Metals Holdings. What are these guys all about, and why did you invest in them?
Well, European Metals Holding, it represents the largest hard rock lithium deposit in Europe. It's strategically located in the Czech Republic. We got involved, at a much lower level, probably around when it was around 12 pence a share. And our returns on that asset to date have been around the 260%. And it's why we got involved with it was because when we saw it, when it was an early exploration asset, it was a very large lithium and tin deposit. We got involved very early. Went all the way through PFS, and it's now doing its definitive feasibility study. And when it did its pre-feasibility study, the valuation that they published was 1.944 billion. And we've got about 6.5% of that. And in addition to it being very large and will supply battery and lithium carbonates for Europe, it's strategically located in the Czech Republic. And when we look at the onshoring process that's occurring now in the US and Europe, where people are looking to source their metals for the transition to net zero and electrification of cars as local as possible and not being reliant on places like China, European Metals is one of the best, or the best, we believe, the best asset in Europe to deliver that.
Okay, well, that's strong, but you've already got, 260% return on that. What would you be looking to exit at a certain point in time or return level?
I think overall, we're trying to look for a 300 to 400% return over our whole portfolio. And as is of this date, our whole portfolio, which includes other sort of our public portfolio and our private, looks at a return at the moment for about above 335%.
Okay, but you're planning on holding EU Metals for a little bit longer yet as they go through the DFS, is that right?
Yeah, we will do, but as we said in our annual accounts, we do sell some of our assets to fund new assets that are going to deliver the same level of return. So, we did sell down some European metals to effectively fund our investment in Amapá, which when you look at those sort of returns, it's going a 3x and then, going to another 3 or 4x. So that's having the multiplier effect. So that's what we're aiming to achieve. And we certainly have delivered that in the public market, and even assets that were private and we've turned into public have delivered 3x returns, in excess of 3x returns in some cases. And by doing that, we look to increase our market capitalization as the market reflects the underlying value of our assets, or the sum of the parts of our assets.
Okay. And do you know, as of sort of today, what the value on the books is for EU Metals Holdings to Cadence?
Yeah, it's around 5 as of today. I will just do a double check because it's always worth doing that and not misquoting anything. So at the moment, European Metals is worth £5.8 million.
5.8 million. Okay. And we're recording this on the 27th, just for the record there. Okay. Well, let's look at another one of the companies that you have investments in, Hastings Technology Minerals. Can you give us a bit of information on the situation here?
Yeah, absolutely. We own about 1.9% of it. That 1.9%, we got that percentage because we had it was a private asset which we didn't have much control of. So we wanted to provide liquidity events to our company and our shareholders by converting that into a public asset. So we bought that for around £900,000 a while ago again, and we sold it and we vended it in for £5.1 million worth of Hastings Technology Minerals shares. Unfortunately, Hastings Technology Minerals, the performance of their share price has come off quite a bit because of the performance of the commodity they're involved in, which is neodymium and praseodymium, which are used in permanent magnets for vehicles. That sounds counterintuitive given the need for electric vehicles at the moment, but that's where it is. We would see a rebalancing that commodity to come up, and therefore those share prices to come up, and it becoming a larger proportion of our portfolio. But suffice to say, it is a substantial asset, rare earth in Australia. The last NPV that they published was about $1 billion Australian dollars. And so we see certainly upside and more value in that asset as it goes through to production. Again, we invest in it before it was before it was a rare earth asset, it was a prospect. We followed it and kept it all the way through up the value chain, like EMH, and it's now, Hastings is now coming to production. I think it's going to start getting its first cash flow forecast in 2025. Okay. And EMH is going to do its DFS at the end of this year, or complete it.
Okay. And again, value on the books as of today, do you have that?
Yep, I do indeed. The value as of today of Hastings is £1.5 million.
1.5 million. Okay, so nearly double what your original investment effectively.
And when we sold it was much higher, and it's just that the performance of the shares it's very closely linked to the share price of commodities, as you would expect, and that commodity has softened. Although I can see no reason if we are genuinely going down electrification of vehicles, permanent magnets are by far the best magnets to utilize in electric motors, and therefore there should be a demand of that. And given that the majority of rare earth minerals are produced in China, and we want to have more of an onshoring aspect of this, you can see how Australia will be important in the provision of rare earth magnets.
Indeed. Okay, well, the other project or company, I should say, that you have a stake in is Evergreen Lithium. I believe you've got, 8.7% of this company?
Yep, again, yes, 8.7% of the company. This is sort of a bit like what EMH used to be when we originally got involved in it all those years ago. It's an early exploration project. And a hard rock lithium in the northern, it's got two assets, but the main one's in the northern territories of Australia. Mm-hmm. Why is it interesting to us? Well, in essence, it's right next to core lithium. Core lithium is a substantial hard rock lithium deposit in production, and the geology in terms of all the geochemical signatures, the geophysical signatures, and the trending surface mapping and surface sampling indicate there is a similar deposit of that size and nature on the concession that in Northern Australia. Now, and they have Evergreen Lithium said there's a potential for a world-class deposit there. Now, its proof is in the pudding. When they start drilling that asset, when they start discovering it, we can hopefully see a much improved performance in terms of where we see this asset going and developing into, hopefully a producing asset. I would say, again, this was one of those assets that was sitting as a private asset, and we didn't want to get involved so much in that. So we then spun it into, alongside the rest of the shareholders, into a public company. And for us, that Evergreen Lithium, just on that move and the current share price, has already delivered a 200% return. And if they achieve certain targets, we get a further $3.4 million of shares in that company, delivering a further return to us. So again, you can see the pattern here. Find something that's undervalued, unappreciated, do something, either be involved in it or get it out to, if the market's not really appreciating it, getting out and spinning it out and accreting that value to our market capitalization. And that's what we've done with Evergreen and Hastings.
Okay. And again, what's the value of Evergreen today to Cadence?
Yeah, £2.5 million.
£2.5 million. And what was the original?
It was about £600,000-700,000. So
okay.
It's about a 206% return.
Indeed. Okay, and the thesis stays the same. You were looking to sort of 300 to 400%, looking to exit when you feel there's a good point to exit, not necessarily when you need the cash.
Yeah, and in that case, this is a longer burn because it's early exploration. The best value you get in any asset, assuming that it's successful, is from this early exploration all the way up to pre-feasibility. And we're anyway, as part of the ASX listing rules, as all founding shareholders are, locked in for 2 years. So we really can't anything. We're waiting for this bun to bake, as it were. So okay. We have to wait for that to happen. And certainly, why we liked, as I said, all the geophysics, geochem, surface sampling that we did lots of that surface sampling initially, really point to a very good asset.
Okay, so just doing some quick calculations there. The current value is around sort of 9.5 million to Cadence at the moment. Cadence?
Yeah, 9.9 million, because we have some other small stakes in other sort of lithium assets as well, but nothing material. So it's about 9.9 million pounds of value, and the total gain on that portfolio as of today, as I said, is about 330%.
Indeed,
unrealized and realized gain.
And just looking at Cadence's current market cap, around £15 million. So that's about 2/3 of that market cap is already covered there in those investments.
Yeah, absolutely. That's what it's made. And I suppose what we're trying to talk about here is how the market doesn't really not appreciating Amapá for what it is.
Let's talk now then about the other projects that you have. You've got a stake in Sonora Lithium or Mexela, which is a private company, isn't it, owned by Ganfeng? So just tell me a little bit about that first of all.
Yeah, look, this is an asset that we invested in quite a while ago. It was originally under something called Bacanora Lithium, which got bought out by Ganfeng. We had already sold. We had a public equity stake in Bacanora. We'd sold out our stake in there, but we retained a small part of a license. So effectively, the Sonora Lithium project is again a very large lithium project in Mexico, multi-generational. It's in a clay deposit. Bacanora went through to bankable feasibility study with Ganfeng Lithium, probably the third largest lithium producer in the world and owner of assets. And they effectively bought it out. We have now effectively, the net present value of the DFS was 800 million, and their protection target was about 35,000 tons per annum. Now, our asset lies within these other licenses, which are 100% owned by Ganfeng Lithium. Our asset is within those licenses, and we have 30% of it. So, if we were to look at what would be mined from our areas, it would be about 72,000 tons of material be mined from our areas from years 8 to 19 on the production plan of 35,000 tons per annum. So again, it's, they still have to construct the asset, and they then have to effectively mine it. And then it will come to if they stay at these sort of 35,000 tons per annum battery grade lithium, which is, so for a reference point, about 35,000 tons is enough for 500,000 cars a year or something like that.
Okay.
If they kept to that rate, we'd be mining 8 years, 8 to 19. If they increase the rate, then our areas come in earlier. And it's not, people often ask, why would they mine your areas later? It's pretty simple. It's geology. Effectively, on their area, there's much less overburden. There's much less rock to take off the top before you get to the ore, the stuff that gets processed and turned into lithium carbonate. In our case, there's much more rock above it, so it's less economical, and therefore you mine it later on in your mine life as you want to mine the stuff that's got the highest NPV first.
Indeed. And you'd be looking there to get what revenue off of that, or what's the exit sort of strategy here to realise value?
I think for us, our exit strategy would be something like Hastings, if at all possible. But of course, that's up to Ganfeng. And at the moment, the Mexican Senate elevated lithium deposits as to a strategic mineral. So there's still some toing and froing of, Ganfeng's sort of having some country certainty in developing this asset. It's very clear that, they have said, the Mexican government has said, all the licenses that are granted are still valid. So these licenses have been granted, so they're still valid, still under the ownership. But I think Ganfeng wants much more surety than that.
Okay.
There's sort of, and so we would call that, our longest term investment in terms of return because of, effectively some aspects of country risk.
Indeed. And do you attribute any value to this on your books at the moment?
We just attribute it at cost. So a few $1 million.
Okay. Well, a longer term plan perhaps, but that's always good to have. Let's finish now then by talking about the Amapá iron ore project. That is your flagship project. I wonder if you can sort of introduce that. I know it has a lot of history, doesn't it? I think it was producing at one point, but there was then some problems and it stopped, and you're currently in a process of sort of a PFS, DFS with getting it back up and running. Is that right?
Yeah, absolutely. So you're right, it has some history. It's important to understand that the Amapá project is an iron ore deposit, and it's not only the mine, it's about owning the full infrastructure or having concessions. So you have both the mine, you have the railway, which is about 196 kilometers railway, and you have own a port. One of the things about iron ore people need to understand is that you might have a great grade, a very high grade asset, but if you don't have the infrastructure, because it's a bulk commodity, you need cheap transport and access to port. Those two things often can represent a very large proportion of cost, but because we own it, and we will be running and operating our port and the railway, therefore we have a relatively low cost. So, you're right. It was discovered in the 1990s, started producing ore in 2007. And then by 2012, it was producing about 6 million tons of iron ore concentrate in various product streams. Then there was a port failure, which it transferred ownership from it was under Anglo. It had a Anglo-American, and it had a port failure. That port failure basically meant, although they could continue to produce 6 million tons a year at the mine and the railway, the port failure meant there was very limited capacity which they could sell. So I think there was about 3 million tons a year that they could sell based on a lower sort of access in terms of port. So that, alongside a lowering in iron ore price to whatever it was, $40 a ton, effectively meant it went into effectively Chapter 11. Through several years, Chapter 11, we recovered it alongside our JV partners out of Chapter 11. We own 30% of the result of an investment of about $9 million. We have a right to go to 49%, and we are now, developing it. We've taken it to PFS. The next stage is DFS, and of course, eventually production. We completed an NPV on it, and the NPV of the asset is $949 million.
$949 million. Okay, so considerable value attribute or under the NPV there. So effectively, it was a port that collapsed, was it? Did you say?
Yeah. So what happened was I wouldn't go into the geotechnical reasons for it, but in essence, a part of the port just went into the river, slid into the river, and as a result of that, took out the berthing that was already there, and took out a substantial portion of the land. So what happened is, when it was being, it was partly repaired, about 80% of it was repaired. So hence, we don't have to repair as much of it, and the capex is not as much as we would have originally expected. But nonetheless, to develop this asset, the capex is around about $400 million, of which about 130 million will be spent on the port.
Okay, so there's a fair bit of money required there to redevelop it. Before we go into the plans, so this was Anglo, owned by Anglo, but given the port failure and the problems there, and then of course with the iron ore price, it was effectively had to go into as you say, into liquidation sort of thing. And then
it's a Chapter 11, which is a protected way, and we effectively came in 2019. Okay. And during that 2019, we didn't own it. We put some money in escrow, $2.5 million, and then we negotiated with all the creditors, put a plan together alongside our partners and their lawyers and all the rest of it, our lawyers, put together a plan for the creditors, both the secured and unsecured creditors, reinvigorated all the filings that the company hadn't been doing for the last 5 or 6 years. So there was a whole administrative process, which eventually resulted in us, and one of them was a settlement with bank creditors, with us getting ownership actually only in the initial part of 2022.
Okay.
And so really that's when we really started, we owned it, and that's when we pushed the button in terms of getting the PFS done. PFS took us about a year, and in the interim process, we'd previously got a federal license on the port. The railway concession has been renewed. We're going through the licensing process, the environmental licensing and permitting process, all of these risks that people sort of think, ignore or don't really pay attention. It's a lot of effort and time. And that's what we've really been doing. Last year was predominantly PFS. This year has been about licensing, social licensing, and other aspects that we can talk about in terms of developing the asset. Okay. But ultimately, that PFS comes out with a really good value, an NPV of 949, would be higher now because iron ore price is higher. Okay. And, a cost basis of delivering 5.2 million tons a year, of about $35 a ton, $64 a ton to customers in China, when that product at the moment is in excess of $120 a ton.
Okay. So, and you picked up for an investment of, was it 9 million, you say?
Yeah, 9 million in several stages. Our first stage was 2.5 million for 25%, but that's when there was all this risk, all the JRP, risks of creditors. But the way we structured it was, and we wanted to protect our investors' money, is that unless all that JRP was, or this sort of court restructuring was done, the 2.5 million wasn't released. Sure. So it was only until that legal risk, unknown external risk, was eliminated that we could then release the 2.5 million. We got our first 20%. We quickly followed it with a further 3.5 million, got us to the 27%.
Okay.
And then last year, we basically took us up to 30% for the remaining up to 9.3 million. We recently raised capital through debt earlier on in the year, but that, overall, that should take us to 33% during the course of this year.
Right, so you should get to 33% over the course of this year, and then 40% would be the maximum you could take. But you are the operator, the main operator of the project. We
could go up to 49%.
49.
The maximum I could take at roughly the same price that we're paying now, about $1 million a point, $1 million percentage point.
Okay.
And we are a 50-50 JV effectively operating with our joint venture partners. So, I'm on the board of the joint venture company. We make decisions together. Okay. So it's a very active management. Last year I was probably spending about 80% of my time. This year it's probably sitting about 60% because it's less to do the technical stuff in terms of pre-feasibility study, which I come from a background of.
Indeed. And that 1 million per percentage point, and is that direct investment, or is that money spent on the project as well? Would that count?
So it's none of this money goes to the vendors. It goes all into the asset.
Okay, fine.
So the 9.3 million has gone into the asset, hasn't gone in anywhere else.
Okay, that makes sense. Okay, so talking about getting value from this, if there's an NPV there of 949 million, an estimated cost of 400 million to get the port back up and running. So that's a considerable amount of money. You say at the moment you're focusing on licensing and environmental permits. Is that right? So, I mean, what's the focus on at the moment with Amapá?
So after the PFS, there was three. Basically, what we're focusing on now is continuing to develop the asset, given the capital constraints that we have, and focusing on some aspects that PFS have identified that could add further value. One of which we've already reported on, which was a port improvement that improved the capex by, I think, 20 million or thereabouts. There are two others that we're working on at the moment, which is possibly increasing the resource size and looking at some adjustments to the processing route, which might increase the grade of the material, and reduce the cost. So you get a higher unitary cost that you would get on revenue and a lower cost production. So those are the three things. We've done one, we're processing it, we're doing the other two at the moment. And then the other part of it is, to operate this mine, you need operational licenses, which you need an environmental permit for. And we already had started some of that environmental permitting in terms of the background studies that needed to be done. And we are ongoing with that environmental licensing process, which previously, if it was a greenfield site, just to give you an idea, would take about 2 years to do the whole environmental background study, and then over about a year in Brazil to get the license. But because it's already established that process, so we've already had the environmental impact because the mine, the port, and the railway are already there, we should be able to shorten that stuff substantially. So it was not a bottleneck, I would call it, at this point in time. So we're really focusing on that, making sure that we can deliver that as soon as possible, because the next stage will be to do a DFS. And really, to get a really good bankable DFS, you need to have that environmental license saying that, yes, you've got the right to install, i.e. install new equipment, build, and build the asset, because then it becomes a truly bankable DFS, because both you have a really good economic understanding and you have the right to build it. A DFS without that licensing then sometimes can drag on because you won't get the banking finance until you have the right to install and build stuff, right? No one's going to give you money if you can't build the asset. So that's really important on how we're putting that together.
So you're working, go on, sorry.
And of course, it's then how do we get to the DFS?
Yes, exactly. So you're working on these, what I call pre-DFS sort of elements before you start to go down the DFS route. When would you hope to have these completed by and start work on the DFS? So
we're liaising with the Amapá government. They've provided what we call a terms of reference, and we're liaising with them which parts we need to be doing, and then we can provide a definitive timeline. What we do know is that it will be shorter and substantially shorter than a timeline for a traditional licensing.
Right. Okay. But at this point, you don't want to say exactly when. Don't want to set expectations. That's understandable. But in terms of funding up to DFS, how is that looking?
So that's fine, and that's what we raised the $2 million for. That's an anticipated amount that we would require to do the work. Primarily of the studies that we talked about, and really that money is going into Amapá. It's going into the running cost, maintaining the dams. The other thing is that it's a historic mine. You have dams, tailings dams that need to be maintained and relicensed. That's a really important. Put in all the emergency sirens, cameras, and all the rest of it. So it does have some complexities because it's not greenfield. So there is an ongoing running cost that we always need to keep there. And that's including security guards, because there's substantial assets there, an old mine, steelworks, ball mills, storerooms, a port. So it's not a greenfield that you just don't have anything to look after. We do have that aspect to it as well, which we're ongoing and ensuring that by the time we get to completed DFS, we're as well advanced as we have in all of those social engagements, social contracts, environmental permits,
Okay.
Done and dusted.
Okay.
So, carry on.
Well, I'm just going to ask another question. Are there a lot of ongoing costs at the moment to keep things as they are?
Yeah. So as I'm saying, they're on an ongoing basis to progress the licenses, to progress the dam licensing, has an ongoing cost. And for security, yes, you have to keep people there monitoring and ensuring that all these assets don't get stolen or they're preserved. So we do have to have geological engineers on site. We have to have general management on site, and that's all covered. And that's, the money that we raised is to cover that cost as well as those environmental costs.
Perfect. Okay, well, thank you for that. That gives a nice high-level overview of everything. I'm sure there's a lot more detail we can go into on the projects, particularly Amapá. We can maybe do a special feature on that and take a real deep dive look into it. Just a final thought, of course, longer term, you're going down this value curve at the moment. You're going to go to DFS. What would be the exit plan? I mean, maybe loosely in your mind, what would you look? Because to raise that kind of money it's possible. You can debt finance it as well. But have you got any exit strategies or plans in mind to keep this owned and develop it in the longer term when it's appropriate?
So one of the things, obviously, traditional, what most people would do is they go from PFS, go out to market, raise the capital for DFS. And certainly, if our market cap was much more reflective of our asset value, that would be something we would have considered. But given where the market capitalization, the dilution to our shareholders by raising money for a DFS, it would have been quite punitive. I'm a substantial shareholder. I'm a substantial shareholder with about 1% of the company. So like other shareholders, I don't want that dilution to occur and mitigate that as much as possible. So then we have three ways to look at develop this. The first one is, which we're actively and is our primary choice, is to get a strategic partner, joint venture partner at the asset level in Brazil, who would provide the equity in Brazil, take an equity stake in the asset in Brazil, and therefore provide enough for the DFS. That equity partner could be, of course, a strategic investor from abroad, which might, have some engineer EPCM funding associated with, or have the first right of refusal of the EPCM funding. So that is the engineer could construct and manage of the eventual project. So we have a data room that is open, and we have several parties looking at that data. It does take time because they're going through the full PFS document and its financial model. The actual PFS document is probably about 600 pages long, but the backup engineering work is, reams and reams of data, of gigabytes of information that needs to be gone through. So that is one option. The other option is, if there was a buyer out there that offered us a sensible amount associated with this asset, we would definitely consider and could look to vend out in its entirety. The proceeds of which could be reinvested or returned to shareholders. And the third one is pretty well would be effectively taking this asset and spinning it out into a market that would appreciate this asset for its value. And that to us would certainly be the Australian Stock Exchange, and something that's actively we are looking at, and looking at, would it be suitable, what's going to cost, timelines and stuff like that. So those are our three exits, and really, and realizations, right? So I think these have been driven out of the fact that if we look at just on a book value basis, the purchase value of our equity, and it's a bit old, it's looking at the presentation at the moment, it's earlier in this month, was about £4 million. When we look at our £4 million, the purchase value of our private assets, including Amapá, so it includes the Sonora, was 12.3 million quid. So the total purchase or book value is 15.9. But when we look at the increase in value of the public equity, that's gone up by 6.8 million quid. and the increase in value of Amap as a result of us paying sort of, value at 100 million is 19.5. We have a total book value of investments, 42 million quid, market capital is 15. Clearly there's a disconnect. And whether that the market doesn't appreciate it here or, it prefers a much simpler story. So that's why we're thinking of either spinning it out, getting a JV partner which will understand that book value and pay the right price for it, or of course a sale where, of course, the market appreciates cash.
Indeed. Well, you've got a few options there to think about, Kieran, and it's good to get a bit of a taste of what could happen there for Amapá. But thank you very much for now, the CEO there of Cadence Minerals, Kieran Moseria. Thank you very much for your time.
Thank you.
If you enjoyed this interview, then give us a thumbs up, a like or a retweet. Subscribe to us on YouTube or follow us on Twitter and hit that notification bell to be the first to know when we release new content. There's loads of great content on our website too, across all our programs at stockboxmedia.com. Thank you for watching.